Welcome to Just Some Guy Trading with 2021 World Champion Trader Kevin McCormick. Welcome back to my weekly outlook for the week of May 1st. I'm Kevin McCormick, and this week we're going to cover the S&P 500 and the up-and-coming Federal Reserve rate hike meeting, crude oil, gasoline, natural gas, soybean meal, soybean oil, wheat, and corn. A lot of content again this week, but thank you to all of the new viewers last week. A lot of content last week and everybody enjoyed it. We had great viewership. Don't forget to hit subscribe so you know when these videos come out every week. With that said, let's move ahead and start talking about what we see coming up for the week of May 1st. As always, this presentation is for educational purposes only. Okay, just like last week, I wanted to hit on earnings, and let's start off with a recap of the earnings we had last week. Ton of earnings came out last week, and the estimate beats continued. You are not hearing this from the negative talking heads on TV and the media right now. The fact is, 52% of the S&P have reported, 79% beat estimates, 7% median estimate beat, 73% top line beat, and that's a 3% median beat there. This week, heavy again on the earnings. It's going to be a volatile week, folks, because of the earnings reports. And as I'm recording this, it sounds like First Republic Bank is going through having its assets sold off by the FDIC. So it's going to be a crazy Monday. And we have the Federal Reserve meeting this week where everybody's expecting a quarter rate hike on Wednesday. But the real key is going to be the tone that Jay Powell gives the market after the rate hike. If we get anything other than him leaning towards a pause, I think it's going to drive the market lower. And that's going to give the opportunity for the hedge funds to start covering those shorts or keep pressing them, as we'll talk about here in a few minutes. Let's recap what happened in April and where it has us on the third year presidential cycle. I'm not going to go big deep into this, but go take a look at the April special report I did if you want to know more about the presidential cycle, which in my opinion is one of the biggest driving factors in the stock market. So April, I was looking for a 3% return. We actually ended up with a 1.5% return around there in the S&P 500. And you know, it wasn't as great as I had hoped, but it was still a positive month, which gives us a good setup for this cycle to continue. But going into May, are we going to need to sell in May and go away? Or are we looking at a continuation of this rally? I really think this week is going to decide how May goes. But one of the positives that came out of us only having a small return in April is if you look at the historicals, small returns in April actually have a tendency to set us up for a positive May. So we have that going for us, but it's really hard for me to ignore the seasonal trends and cycles that we have hitting right now in the first week of May that are indicating that we could be going lower. We'll get into that here in a minute, but really want to hit on this for all the viewers. May is a coin flip month when it comes to if it's going to be positive or not in the third year of the presidential cycle. And right now, I'm leaning towards 50-50 on if we're up in May. So with that said, let's jump into the S&P 500 chart and talk about where we could go next week. Okay, let's kick things off by taking a look at the Williams True Seasonal for the S&P 500. This is one of the seasonal patterns that I'm discussing when I say that May, right here, right now, is when the market typically starts to roll over and we have a decline until we get the end of the year move higher. We also have additional cycles and the presidential cycle that I discussed before that all point towards May being weak. And I would be leaning more heavily towards this trend continuing if it wasn't for the positive earnings that came out and the Federal Reserve meeting on Wednesday. Really, if the Federal Reserve doesn't surprise the market and gives us an indication they might be done raising rates, I think May could buck the trend and move higher. Why do I feel this way? One of the things, just like I said last week, that is driving this opinion is the unbelievably large short position on the hedge fund community. Shouldn't be a huge surprise because they're always going on TV telling everyone how the market's going to fall apart and everything's going down. But they tried last week with the First Republic news to push the market down, but companies coming out with positive earnings pushed it higher. And instead of starting to cover shorts, they increased their short position this week. The COT report doesn't give us the data of what happened on Thursday and Friday, so we don't know if some short covering happened already. My hunch would be that they're keeping this short going into next week, hoping that the First Republic bank failure that's going on this weekend, plus the Federal Reserve meeting, is going to give them a chance to push the market lower. But I can tell you guys, historically speaking, when the hedge funds get this short, it usually results in a market rally. So take a look at the market as you want and your different signals. But this is my ideas for the S&P 500 based on these indicators. Next, let's go take a look at the chart on the symbolic platform. All right, and this is what I want to highlight with the S&P 500. We're taking a look at the chart here with the DeMark combo and sequential indicators on here. We had this great sell 13 and identified this TDST line as the area of resistance going all the way back to September of 2022. This was put in place, and we've held this resistance throughout this time. But we have this great trend line here that's moving higher, and this one moving down below. And I think we could have a breakout here. But what's holding me back is I don't know if this is going to be a breakout that really takes us much higher, or if it's going to be a short covering rally that's going to cause that short position by the hedge funds to have to be closed out. And then once that liquidation is done, if we're going to fall back in the month of May. I don't know which way we're going to go right now, but I think for nimble traders out there, it's going to be a great trading opportunity because I expect big swings for the first week of May. And then after that, I'll be able to take a closer look to see how it looks like we're set up for the rest of the month. Now let's jump into the energy markets. Okay, we're going to start off by taking a look at crude oil and gasoline using the DeMark indicators. And you'll see here that on Thursday, with the crude oil contract, we had a DeMark buy 9 that hit over here. And we actually had an instant reaction from the market, and it moved higher on Friday. Resistance levels are really down here at 66. My viewers know I've been saying I think we're going to be in a trading rate for crude oil from 65 to 85, possibly 90, but the OPEC cuts didn't seem to goose the price as much as we expected. The OPEC cut announcement over here, gap has been filled, that I think probably would have stopped this 9 from working before. And in addition to that, on crude oil, on a weekly basis, we hit the sequential 13 buy last week. I haven't done any educational videos on the DeMark indicators yet, but there's 2 of them that use the 9s and 13s, combo and sequential. Sequential will count in a sideways moving market, whereas combo counts in a trending market. That's why we're seeing a 13 here from sequential, which could be indicating seller exhaustion in the marketplace today. And crude oil is still in a premium market despite all this news going out. Front month is priced higher than the back month, which means there's still plenty of demand out there for crude oil today. But with that said, let's take a look at gasoline. Why do I want to take a look at gasoline? Because unlike crude oil and heating oil, gasoline supplies in the US are actually unusually low for this time of year heading into the driving season, which could cause prices to move higher into this summer. And if you live in one of those areas where we don't have pipelines, you could be looking at a serious increase in your gasoline prices coming this summer. You'll see with the DeMark indicator, we had a similar setup on Thursday. The 9 hit. We got a reaction on Friday, not as large as the crude oil, move, but you'll see here that our decline has moved us properly closer to this area of resistance where we'd expect the market to move. So I'm leaning more towards gasoline as the trading opportunity going into next week, but I think crude oil and gasoline are set up for a move higher for next week. With that said, let's take a look at natural gas for all of you out there who are always asking about natural gas. Okay, just a really quick look at natural gas. As I've been saying for weeks, we need to get a confirmed breakout in natural gas. And we haven't had it yet. You'll see on Friday we had a large trading range, but it pulled back down. We finished the day still closing above the 18-day moving average. The one area that's giving me a positive look is you can see here that we've been staying flat with the moving average, trading and closing just above it. And for the first time in probably 6 months, we've spent more than 5 bars above the will stop level that I like to use as a indicator for entry and exits in the market. So do I think we're ready to get long natural gas? No, but as I've been saying for weeks, it looks like it's forming, and we just need that confirmed breakout higher in natural gas. We're done with the crazy contract rolls for any of you oil traders out there. So that's why I think that we're set up now to maybe make this breakout, because the contract craziness with natural gas is alleviated for about 30 days. All right, now let's take a look at the soybean complex. Soybean meal and soybean oil is what I'm going to be focused on today, but I wanted to just highlight how crazy the long liquidation by the hedge funds was last week with the contract rolls, and nothing explains it better than the soybean COT report. You do not see large moves like this in 1 week very often. And the really amazing thing is that it didn't drive the market down lower. As I've said before, the commercials actually want or produce the commodities, and the hedge funds are just large speculators like us who are trading millions and millions of dollars on the contract but don't actually want the commodity at the end of the day. And man, did they liquidate heavily. But the commodity itself, you can see we did not break these lows. So it looks like soybean complex is moved to go higher. Now let's get more specific by taking a look at soybean meal. So the setup, as some of my viewers we had a little chat about it, pointed out, the setup for soybean meal and soybean oil is terrific right now. We got sentiment that's too low. We have the seasonals working in our favor. As you see here, we should start moving higher right here, right now. COT report for soybean meal is positive as well. And then I'm going to highlight one of the last little pieces that makes me like soybean meal right now when we jump over to symbolic charts in a moment. But I just wanted to highlight these setups here. And we're in a premium market for most of these commodities right now as well. Very unusual, heavy buying in the front month. But we have some, like last week, the long liquidation happened. Some funky things that have been going on around the world with the grain markets. So before I jump over to symbolic, let's take a quick look at soybean oil as well here within the TradeStation platform with the Williams indicators. Same thing here as well. Sentiment has gotten low. I take this as a contrarian indicator, as my educational videos have highlighted. So this is actually one of my buy signals. Same thing with seasonals here for bean oil. We should be moving higher right here, right now. And the COT report as well, as we'll see here. Commercials have been buying for a long time. They've actually moved into a net positive position, which is very unusual for the commercials to do this. It's really tough to look back all the way back here to 2020 of May, but you can see here when they got this long, we started a much higher trend moving up. And here where the funds were liquidating their long positions in soybeans, they were doing a little bit of the same here in soybean meal, giving us what I believe to be is a soon-to-be bottom in soybean meal and the entire complex and soybean oil. So let's do a quick look at the DeMark chart, where I'm going to highlight that I think we might be having that bottom identified this week in soybean meal. All right, and here with the DeMark indicators, I'm really liking the setup in soybean meal for this week. If we get just a little bit more of a pullback down, we're going to trigger a 13 buy signal and a 9 buy signal with the sequential indicator, and it's occurring perfectly at this area that we expect to be resistance to this decline. So we expect there to be a bounce off of this dotted line unless we get a confirmed breakout lower. So that's why I'm going to be watching soybean meal closely this week to get that initial pullback that's going to trigger the 9 and the 13 for seller exhaustion, and then look for buy signals myself in soybean meal. Next up, let's take a look at wheat and corn. You're going to see a trend in the grain complex. It's true across soybeans, wheat, and corn right now. We have multiple indicators showing that the bottom is being formed and could be in soon. The one thing I'm worried about this week is, depending on what happens to the Federal Reserve, we could see a spike higher in the dollar, which could pressure these prices down a little bit more. But as we're about to see here with wheat, we have hit multiple selling exhaustion levels with the DeMark indicators, and we're in areas of resistance now. So I think it's a good time to be looking for and taking buy signals in wheat, corn, and the soybean complex. Right here on this chart for the weekly contract of wheat, you can see here that we had a 13 that hit back here in March. We just recently got a weekly 9 buy as well. And we're pushing right up against what is expected to be the buy risk area, which the DeMark indicators draw automatically for you, indicating that this could be the area where this, if you were going to go long, that we'd expect to hold if the decline continues. So we're right near that area, which makes it a little bit easier to step in and maybe get long here after what happens. And then on a daily chart, you can see here we had the perfected 9 back here. We had a little bit of a reaction. This resistance level held, and then we went down below and we hit our 13 sequential and our 13 combo on Thursday. So we have the weekly and the daily indicators for selling exhaustion aligned for the wheat market. Very strong signals when you combine that with the indicators from Larry Williams in the COT report. The commercials are net buyers. We have a premium in the wheat market, all indicating that fundamentally speaking, it looks like the selling is done and we should start moving higher in wheat. So I think we should look for and take buy signals in wheat as well for this week. Now, let's finish up with a quick look at corn. All right, let's just finish up with a little recap on corn. I'll highlight just like the others. COT report is good. Commercial buying sentiment is positive on corn. Premium market here as well. So this decline should be coming to an end. If you go back and saw my video a couple weeks ago, I highlighted this divergence we saw in the open on balance volume and the rise in price as an area of caution for us. And man, did this help us out, because we went up here, hit this high, actually got a DeMark sell signal here for buying exhaustion, and the market made us move lower, and that on balance volume corrected itself, and now we are down here as part of that long liquidation. And as you can see here, we're using the Williams Progo as well. We can tell that the professional buyers were in here buying the whole way up, and just like I said, this bar indicated buying exhaustion, and boy, did the liquidation by the large hedge funds start here. Now that the contract rolls are over, I think the long liquidation is over, just like in the other grains, and we can start looking for and taking buy signals in corn. Thanks for watching Just Some Guy Trading with Kevin McCormick. Don't forget to hit subscribe so you know when all of my great content comes out.